Hey everyone, Brian Bogner along with Gregory Towner, and it is, of course, time for our October edition of the 20-minute market breakdown. And we're excited to come to you this month because there really is a lot happening. I guess here in about 2 weeks, we'll have this thing called, what is it called? What is it called, Greg? What's going to happen in 2 weeks again? I
Election?
forgot.
Is that it?
Oh, the election. Yes, that's right. Oh, that's right. We're going to have this thing called the election. And I think over the next 2 weeks, any noise or craziness or things that we have seen is going to be amplified by 100. So we want to talk about the state of the markets heading into this election, what you need to know and what you don't need to know, and avoid and eliminate. I think sometimes figuring out what you don't need to know and eliminating that is actually more important than knowing what you need to know. So we're going to go over all of that with you. So let's go ahead and, as you know, we're gonna dive right into this. Greg, let's start with this question. Uh, the Fed has been lowering rates. Well, they've had one lowering, and they're in a posture of potentially lowering rates and easing right now. And as we know, they lower on what we call the short end of the curve, meaning the kind of the overnight short-term interest rates. But as they lower rates, what we've seen is we've seen longer term rates actually go higher, like the 10-year yield, which is based on our mortgages, our car loans, or all these things are based on the 10-year yield. Those things are actually moving higher. So talk to us. Why would is the Fed's lowering rates trying to bring rates down? We're seeing long-term rates move up.
Yeah, I think everybody was excited. A lot of people were excited about the Fed cutting rates, thinking, "Oh, okay, great. I'm going to be able to, refinance my mortgage at a lower rate or get a new mortgage or something like that." But things changed pretty quickly after the Fed cut rates. There was only maybe a day or two later, there was a big monthly jobs number that showed the job market was stronger than anticipated, perhaps stronger than the Fed thought. And there was a series of other economic data points that came in stronger than expected. In fact, we were looking at a chart recently of the what's called the Citigroup Economic Surprise Index, a well-followed index in our industry. And we kind of overlaid that with the 10-year yield that you referenced, and they were moving in lockstep. So, in other words, as economic data was coming in better than anticipated,
Hmm.
the yields on those longer dated bonds were going up
Right.
because, yeah, people were having to factor in, oh, wait a second, maybe the economy is firmer, which means what? That the Fed will not be cutting as fast as anticipated.
Right.
You know, a lot of people thought, well, they're going to cut another 50 basis points here soon, and now it's looking less like so likely. So the economy looks like it's gained a little steam, or is at least not slowing down like
Hmm.
the Fed thought it might be. So the Fed is going to be cutting rates even slower.
Yeah. Yeah. Yeah, and I think also it gets to this thing is that whenever you think that whatever that conventional wisdom is, like, well, if the Fed's cutting rates, then this will happen. That doesn't, I feel like more often than not, whatever you think is going to happen, a lot of times we get surprised and that doesn't happen. So you have to be very careful, coming up with absolutes on the markets and things like that. Well, speaking
Yeah.
specifically of the market, um, tell me, is market leadership? Let's talk a little bit about that because obviously we know what's been driving the market here over the last 10, 15 years, right? The big US large cap tech stocks, right? The mega caps,
Right.
and we've had the Magnificent Seven, the Fang, we've come up with all these different names for all these stocks that have been driving the market higher. Are we seeing a shifting in that?
I'd say we're seeing a broadening right now. That there's
Okay.
still the US and US large cap is still, the leadership. It's still the best performing on in general. But under the surface, there's a lot more happening than there had been. You know, pockets of technology are still doing well, but not necessarily all of them charging higher. But we're seeing areas like financials, for example, the banks are doing well. They've all reported their quarterly earnings here recently, and they were really good. They had good comments about the commercial real estate that's been everybody's concern, so that hasn't been as bad. So banks have been doing well. Industrial, that whole sector has been doing well. Utilities, oddly enough, are doing well,
Right,
partly
right,
because of a lot of spending on AI infrastructure and that sort of thing. So
right.
it's definitely starting to broaden out, and I think some people would be surprised that if you go to a little bit alternative type asset classes, the top two performing asset classes so far this year are gold and Bitcoin.
Right.
So an odd mix of gold and Bitcoin and utilities and things that are doing well. that maybe you wouldn't anticipate. As we look kind of more recently here, we've also started to see some participation from REITs, the real estate investment trusts,
Yeah.
particularly when rates were going down. Emerging markets, which we haven't seen do much in a long time, Brian, they've picked up a little steam, particularly China, for example.
Right.
And I know we've talked about small caps off and on throughout this year. It seems like every time they kind of start to outperform, they kind of, revert back a little bit. So on an absolute basis, small caps are doing okay, but not compared to large cap. And I think the biggest reason for that is they tend to be tied to interest rates
Yeah.
because they have a lot of
Yeah.
floating rate debt.
Right.
And so when interest rates were going down, it looked like, okay, finally, small caps, here we go. They're going to start moving. And now, like we talked a bit about a moment ago, as rates went up a little bit, small caps kind of saw some headwinds. So, I mean, as you know, Brian, there's always rotation going on under the market. But by and large, we're seeing improving breadth of the market. The
Yeah.
leadership, I wouldn't say it's fully changed, but it's improving.
Yeah. And I would also say too that, even though we're having a positive year in the market, right, in stocks, right? Like you mentioned, gold's the number one, followed by Bitcoin. And then even though it's not the best performing, the amount of cash, right, that we have seen go into money markets over the
Yes.
past year or two. So it's kind of like when the market, and I know we're going to talk about this here in a minute, but and then this kind of leads me to my next question is why are we still positive on stocks, because and this is kind of the idea is that when people are putting money into other asset classes and they're not convinced that really stocks is maybe the place to be, usually
Right.
again we get surprised at the upside, right? So
Right.
why are we still positive on stocks?
Yeah, first of all, over the very long term, you're going to benefit greatly by leaning towards the positive side when it comes to the stock market because it's gone up historically over time, and the periods of negativity are brief. And so, whenever people are trying to call for those bad periods, it's really difficult to time that. But under the surface, there's a number of reasons that continue to keep us positive. Obviously, there's bumps along the way, but when you look at what drives the market over the intermediate to longer term, it's earnings growth in the companies, right? Because as
Mhm.
we've said before, people are coming into work every day trying to better themselves and better the
Mhm.
companies they work for, and those companies are trying to, improve their prospects. And so at the end of the day, you want economic growth, you want earnings growth. And all the estimates that we see for next year and the comments from companies are they continue to expect solid earnings growth. So that tends to correlate with positive market returns
Yeah.
uh, right now. And so some of these factors are kind of more shorter term in focus, but
Sure.
the seasonal period that we're in right now,
Right. Right. This time of year.
not everybody believes in seasonals. Markets do certain things, certain time of years. But right now, we are literally just about to start the best seasonal period of the next several months
Yeah.
for stocks. So that's a positive. We talk a lot about behavior and sentiment. I would call sentiment kind of a neutral right now, which means it's a positive in the sense that you really only use sentiment when it's at real extremes. And, from time to time, maybe it looked like it's got a little too positive, but I just feel like there's a healthy amount of skepticism about this move out there right now. And so sentiment is at least a neutral, if not a positive.
Yeah.
Um,
Okay.
we talked at the beginning about the economic surprise index. So the economy, not all perfect, of course, but GDP looks like it's going to come in over 3% again, still growing positively. So that's a tailwind. We believe in technical analysis. So the price trends are positive of the market. We published that white paper over the summer that said historically, when stocks are at or new all-time highs, that's a positive looking forward. So we view that positively. And then I know this is hopefully our last time talking about this, but the election,
Yeah.
we've shown a number of data points over the year that showed after the election, the market historically is like, okay, good, we got that behind us. Let's move higher. So hopefully in the shorter term, we'll see that happen as well.
Okay, well, that's a lot of reasons to be positive on stocks, no doubt. So we've talked about, why did long-term rates go up when the Fed's cutting? Where's market leadership right now? Why are we positive on stocks? So we've got to bring up the part of this conversation, right? We
Yeah.
can't just be positive and talk about that only. So what are the risks? What are the things that we need to be really focused on right now, when it comes to, our portfolios and investments and things like that?
Yeah, we try not to let these things really alter in a great way, the way that we manage long-term money. But you definitely have to be aware of what is happening out there, what some of those potential risks are. So let's kind of separate these a little bit into kind of shorter term type risks as well as longer term things. Well, in the short term, so I just mentioned, right, we're going into the good seasonal period. But the weak seasonal period was we just left it kind of late August into early October. Well, stocks did really well during that period, Brian. They didn't have that negative seasonal period.
Right.
So I can't help but think a little bit that, did the market kind of front run that a little bit? Did it pull forward some of those returns? So I have to keep that in mind. Maybe the seasonal period has kind of already partly happened.
Mm.
And then also, we talked about historically after the election, there's that post-election bump in stocks. Well, what have we talked about exhaustively? Don't worry about the election.
Hmm.
Pointed out in the last two presidential elections, the market went straight up immediately afterwards. I think a lot of other people are finally starting to realize that and say, hey, you know what? Maybe, I won't wait till after the election to invest. So maybe there's a chance some of those both seasonal and post-election returns have been pulled forward a little bit. So that's a little bit of a short-term risk.
Right. Right.
And then tied with that election is if we have an unclear result. If we're sitting here days, weeks, let's not even talk about months after the election, and we don't really know who's going to be in office, the market won't like that. It doesn't like uncertainty. But again, that's shorter term stuff in nature. We've talked about interest rates. This could be either shorter term or longer term concern, but as rates go up, they tend to be more competition for other asset classes, including stocks. So we wouldn't want to see rates go up too much here because that could create a little more risk and a little more volatility.
But don't you think like really rates going up? I mean, to me, it is a thing of inflation, right? So, I mean, could that, how does that factor into it?
Yeah, exactly. So, I mean, we talked about, well, the rates going up is at least partly due to better economic data points, but under the surface, there's certainly the chance that there's other things happening. Are there increased concerns about inflation? There was a Wall Street Journal article recently that said both presidential candidates' policies is likely to increase the debt and increase, inflation. That's just their analysis. Who knows how it will play out? But yes, I think under the surface, there's some concern that inflation could come back, and that would really alter what the Fed is trying to do and alter a lot of things. So that would be a concern. Every month in our viewpoint, we put in risks. The biggest risk longer term is hopefully not something that we have to encounter anytime soon. But if China was to invade Taiwan, that is a massive, massive financial risk for all over the world.
Oh, no doubt, no doubt. And I that keeps me up at night sometimes thinking about
Yeah.
because it's usually one little thing that sets off, a lot of things that happen, and then anything that you have done any type of analytical work or anything like that based on
Yeah,
any assumptions
exactly.
just goes out the window, and you kind of start over. So
Exactly.
yeah, that's a
The,
big one.
the other big one that is, you've heard some prominent names in the industry bringing up recently is the concern about the U.S., debt level. So I mentioned that Wall Street Journal article, and there's been others about both candidates' policies, potentially increasing the U.S. debt even further. And, when is that going to be dealt with? We're getting near the point where you got to do something about Social Security, and so forth. So there's no question that's a risk that, with the bond markets kind of,
Mhm.
get concerned about that. I, I'll say though, that's literally something that's been a concern for investors for many decades, really generations, you could say.
Right.
That doesn't mean it won't eventually, and perhaps even soon, come to a point where it really has to be dealt with. But it is one of the most common, negative points that people bring up. So
Yeah. Okay.
these are all kind of potential downside catalysts that we're monitoring and a lot of other people are monitoring. To some extent, a lot of this, in theory, should be factored into the market. I mean, not entirely because we don't know, exactly how they're going to play out, but
Mhm.
the market factors things in. What it can't factor in is the things that come out of nowhere, the pandemic or, things like that. So you can evaluate all the risks you want, but at the end of the day, there's going to be things that impact the market that you can't fully prepare for. And that's just why we come back to our, diversification, the basics, diversification, quality, focusing more on your longer term financial plan and not the month to month movement of financial markets.
I mean, if you look at what has caused, the recessions and the downturns and things like that, hindsight's always 2020. And we look back on it, it was like, well, of course this was happening. Well, of course this caused this thing. Well, of course that happened. Well, but when we were in the middle of it, it wasn't
Yeah.
as clear as we thought it was. Okay.
Yeah.
And there was maybe a little bit here or whatnot. So what usually ends up causing some type of downside or volatility or something like that is usually something we're not talking about each and every day. Because to your point, when we talk about it and everyone's thinking about it, it's usually factored in the market in some form or fashion. Well, good.
Yeah.
Well, good stuff, Greg. I think again, we did talk a little bit about the election here. We did talk, but what we're trying to do is share with you things that are really important and in many ways more important in terms of your investment portfolio than who gets elected 2 weeks from today. Uh, so um, so with that being said, let's close this out. We always like to give some recommendations. Greg, what do you got for us today?
Yeah, I'm gonna kind of keep it simple here and combine a couple of things. Gonna encourage everybody to spend some time away from all of your screens, whether it be your TV, your computer, your phone, and get outside. I mean, all of us in the Southeast are enjoying some great weather now. I think most of the country is. Take advantage of that. And that will help you with my other recommendation is, as we always say, avoid the noise, never more important than right now in the election season. So get away from the screens, get outside, clear your mind, and avoid that noise.
Awesome. And my recommendation is probably just going to sound like some advice, or maybe even sound like a little bit of a soapbox. I don't know, but I would just encourage over these next few weeks that whoever gets elected, right? Whoever gets elected, part of the country's going to be happy, and a good part of the country's not going to be happy. Probably either way. I think most people I talk to, we agree these aren't the best candidates that we could bring to this year. So, but what I want to say is that we will be okay no matter who gets elected, right? Like we've gone through stuff like this before. The country's not going to end. Things are not going to close down. We're not going to be on a there. So focus on what you can control, focus on what's important, focus on your life, focus on the things that you can control and you have impact on. I mean, yes, we all vote and we certainly can have some impact depending on what state you live in the election, but we have a lot more impact on things around us and things happening here. So my recommendation is just focus on those things, no matter, if your candidate gets elected or not. And just remember that we're going to be okay through it all. So with that, I'll go ahead and close this out. But thanks so much for listening, and we'll see you next month.